Hello, I'm Catherine Gannon, founder of Gannons, a boutique corporate law firm specialised in helping private companies thrive and survive. We deal with all their everyday legal requirements, buying companies, selling companies, shareholders, directors, you name it. There isn't a problem we haven't sorted out. We've been trading for 20 years, growing year on year, and we love it because it's always very exciting. So it depends on what you're selling. But yeah, everyone wants to know what your bottom line is. They want to know what your fees are, what your sales are, what your EBITDA is. There's some basic due diligence. People buy companies for different reasons. They might be buying for synergy. They might not be interested in your horrendous overheads because they might know they can swallow those in their own big corporate organisation. They might be interested in your staff if they're particularly talented and operating in specialist areas. Or they might want your IP because that's the most common reason for sale. They can bolt the IP you've developed onto their IP to develop some bigger product. So lots of reasons and lots of factors go into this. Price is always driven by what are they going to make of what they're buying? How much profit do they think they're going to make from you, as opposed to cost savings. The most basic one for a trading business is normally the price earnings multiple. And they're published, a couple of guides publish what the private companies are selling for in different sectors. And that's the basic. You apply that to the profits after tax. It's a simple back of the envelope valuation. Then there can be various add-backs depending on the particular circumstances, but most look at the price earnings multiple. The other revenue they look at is EBITDA. That's got a lower multiple traditionally because that includes the above-the-line profits and the below-the-line expenses. So they normally look at a combination of both. But some businesses, they're asset-based businesses. If, say, for example, you're buying a property empire, you're not looking at that. You're looking at the value of the assets being purchased. If you're buying know-how and intellectual property, now that's always very interesting because often that intellectual property, it might be a widget or some form of computer program, has never gone to market. So it's never realised any money, but you've still got to come up with an intrinsic value for what that business could be worth. And that's where you see the very interesting valuations. Buyer comes along and the first thing they will do is want you to enter into a non-disclosure agreement, stop you talking to competitors. That's fairly reasonable, fairly standard. The next thing they will do is some basic due diligence. They normally know all about you before they make the advance because there's normally been discussions. And then we have what we call heads of terms. Now that's a very important stage because that sets the framework basically for future negotiations. And that sets down timescales and how much they're prepared to pay. And usually it also deals with how much deferred consideration there will be. And then when you've got through that, and it's a non-binding agreement usually, apart from the confidentiality provisions, they're binding, then they go off and do lots of due diligence. A level of detail will depend on the buyer's appetite. And then we get to drafting the document stage, and that's normally the home run. Depends on the constitution of your company. And that depends on whether or not all shareholders have to approve the sale. If you've got drag rights, basically something along the lines of if 55% or 60% of shareholders want to sell, minority shareholders are dragged into the sale. If you don't have drag rights, then you've got to have 100% shareholder approval. And most buyers will not proceed until they are comfortable with the fact that you're able to secure all shareholders, either through drag rights or through the shareholders themselves. Because what they won't want to do is waste a lot of money on the due diligence only to be turned down or bankrolled. Some smart small shareholder might decide, well, I'm going to bankroll this lot and demand a lot more money to make sure that they're buying 100%. All buyers want to buy 100% of the company, unless they're investors, where they may well be investing for smaller stakes. Are very popular and it depends on the earn-out, but usually that requires the owners, the founders, to stay on to make sure the earn-out is achieved. They need visibility on what the buyer's going to be doing. They need visibility on the accounts. They need visibility on everything. And they need to manage their team to achieve the targets which have been set for the shareholders to receive the balance of their consideration. So yes, it's very common for the owners to have to stay on for an earn-out period, which is usually 1 to 3 years. Well, that's a matter for debate. The people acting for the buyer will want warranties from everybody because they've got more people to pursue in the event there's a breach of warranties. Because the risk with only taking warranties from, say, the directors is they may go off and dissipate their funds, whereupon the buyer may have the best case in the world, but if there isn't any money, there's no point bringing a claim. Shareholders will say, well, we don't know any, in particular on, say, financial matters, we don't know what's been going on. So there has to be a discussion, and the penny can drop in either court. Well, you have to plan. Failing to plan is planning to fail. You need a checklist. You need to push it through. You need a pushy broker usually is a good move because they will be pushing it through. They will be hounding the buyer and hounding the seller. Delays can often cause a lack of finance. Banks can take a long time to lend. The buyer may well need shareholder approval to proceed. That can take time. Sometimes there's institutions involved and there'll be institutional restraints. Sometimes they uncover a nasty problem of due diligence that needs to be sorted and solved. So yeah, every deal has got its tense moments. That's what deals are all about. Where you're dealing with earn-outs, there's always a risk the revenue come along and say, hang on a minute, that's not a capital payment, that's an income payment. Therefore, instead of paying tax at 10% or 20%, we're going to tax you at 45% plus national insurance. So there's some planning required in how the sale documentation is drafted. Also, we need to make sure that you will qualify for the 10% business asset disposal relief. And that means we need to check the circumstances of your shareholding. So there is planning involved, most definitely. You're asked to give warranties on tax, and because we understand all of that, so we've got chartered tax advisors and chartered accountants in the practice, we can deal those tax warranties for you, which ultimately means it's more of a seamless shop. And we understand more quickly where the issues are likely to arise, and also we can make sure the documentation is drafted to put the shareholders in the best position they can be in. In lots of firms, they'll say, okay, we'll do the legal docs, but we don't do anything else. And that means you've got to run around and find other specialists.